It is, and in addition to that, Jeff, as you know, many of the Bush tax cuts are set to sunset this year, and the capital gain rates are still favorable at 15%, at least through the end of 2012. We don't know what will ultimately happen, but certainly there is some rate risk. And as a result, it's a great opportunity to sell an asset that would qualify for capital gain treatment. Typically, a property that is currently being rented would qualify for such if there were gain, and it would be an opportunity to essentially cash out of that at a fairly low tax rate. In the case of if it's held, obviously, if it's held privately, if it's held in a corporate ownership structure, there really is no rate differential on the ordinary and capital gain rates, so maybe not so much of a driver.
And every situation is different.
Correct.
I think you'd agree, and there are times when you can minimize even those lower capital gain tax rates.
Correct.
With the gain.
Right.
We've to give you a couple examples of transactions we've structured. One, we're in the process of structuring now for a small to mid-sized company that is in the home construction industry. They've had, as everyone has in that industry, they've had significant downward pressure on revenues and on profit margins. But they've retooled their company and they've changed their focus and they're starting to grow again. They've got a great brand, but the banks want significant concessions from them to make the loans that they need to continue to grow the business. So looking at the real estate where they have a nice basis, low basis in the property, can sell it for more, to reinvest in the company, relieve the company of all its debt, and reinvest equity into the company to grow its sales force and to grow this new brand that the company has developed and has done well. We also represented on the other side of the spectrum, we represented a multi-billion-dollar international insurance company. They had a local, a United States-based subsidiary. They were writing so many policies that they needed more capital to satisfy the state regulators, their capital requirements, right. Not to get too detailed. But the parent company overseas refused to give them any more capital. They did a sale-leaseback of their operations and were able to increase their sales by 20% because they had more capital base. Right. And for a lot of reasons we could go into in meetings, they couldn't do that as they owned the building, and even if they financed it because of the basis in the property. So it can work for a lot of people in the right situations and be highly attractive.
Sure, no question.
And Jeff, so we've been involved in a number of sale-leasebacks over the years. Talk a little bit about what the expectations are from investors as far as length of lease and just general terms, things of that nature.
Obviously, investors that want to do sale-leasebacks are looking for a lower return with a lower risk. For that lower return, which means a lower rent, maybe a higher purchase price for the corporate user who we represent, means they have to sign typically long-term leases. Minimum 10 years, sometimes up to 20 and longer, depending on the capital versus operating lease
right.
that Mario mentioned. Those lease terms have to be tight and strong for the investor because they're essentially buying a bond from the corporation. And they can be structured in many different ways within that structure, but that's the lease term. As far as rates today, with borrowing rates in the low 4s, some in the high 3s right now, depending on the company, and you don't have to be a Fortune 100 right. AAA credit tenant, but for companies that want to sell their building, the investors can access very low interest rates, right. which equates to a lower rental rate. So and the property prices, while they're depressed, actually for corporate sale-leasebacks, we're always surprised to see that the number is higher when you're doing a sale-leaseback. We're not surprised, but the client usually is surprised.
In terms of the valuation.
In terms of the valuation of what their property is worth today. So again, we said it before, it's something that every smart, interested CFO, CEO should look at for their buildings, at least from a valuation standpoint, to see if it makes sense.
And again, when you end up with a situation where, seller now becomes lessee, you obviously have now taken the payments that you're making and treating them as rental payments, which are certainly ordinary and necessary business expenses that can be deductible 100%. Right. Although you probably have more expertise in this area, I've seen a number of these structured as net leases. And so even in that case, a number of these other expenses that the seller lessee would incur, repairs, maintenance, taxes, et cetera, those are also fully deductible costs. Right. So Whereas, again, as I mentioned earlier, if you have a mortgage, whatever portion of that is principal is not deductible, and you only really have the interest expense deduction. So you might actually end up with also, in addition to the liquidity, a way to shelter additional income through the rental payments.
Right. So Mario, you mentioned earlier capital gains rates right now are favorable.
And not for the corporate owner. I mean, if it's truly owned by a corporate entity, then certainly the rates are essentially the same.
Right.
But in the case of real estate being held through partnerships or other vehicles that have ultimately have individual owners, certainly there's still that rate play, significant.
Are there other tax concerns, considerations that you might want to expand upon, or?
Yeah, another concern, or should I say, consideration is to ensure that the transaction is not between related parties.
Right.
And so it's important, the related party rules in the tax code are pretty extensive, but it's important that you're really looking at and making sure that the parties that are entering into the sale are not related, because if they are, you may in fact not be treated as a sale, or in the alternative, you may limit your ability, if you have losses, for example, on the sale of a property, to utilize those, to take that loss benefit. That's one. Two, we touched upon also, again, the distinction between operating versus capital lease, again, for tax. If that lease goes out, and it can include options, okay, so it's not strictly the lease term, but if the options in the lease effectively go out for greater than 75% of the useful life of the building, then you could potentially create a situation where the IRS would come in and recast the transaction from a sale leaseback into a financing transaction,
right,
essentially. So the structuring of the transaction is, from a tax perspective, is equally important, if not more so, to make sure that it'll meet all the hurdles.
Right.
Unfortunately, there's a lot of case law in the area, and it's a very facts and circumstance driven area. There's not always a bright line that we can point to, but certainly we can work with each situation and find a way to structure the transaction that will meet the IRS criteria.
Right. Jeff, you were going to make a point earlier.
I was. It's as with any other financing or financial option that corporate owners and financial officers and such have. There's different ways to structure this, as Mario alluded to. There's also things that are more flexible, like partial sale leasebacks. And in this time that companies not only maybe in an expansion mode, but are using less space because of technology and things of that nature, or they've reworked their distribution of their office network systems, you can often sell a building, get its full value, and only lease back a portion of that building, which is another interesting mode where you can cap the value of the property, not take on the risk of being an owner trying to lease surplus property, and reduce your rental costs even further. So there are many options that we go through, and it's part of what we do as a team, what we do for our corporate users, to include this along with expansions, contractions, loans on property, enterprise loans, specific asset loans. It's all part of the process.
Yep. Well, as I mentioned at the start of the presentation, it is a very challenging environment to raise capital today. A number of companies are having a liquidity crisis, and a sale leaseback may be an opportunity for you to unleash some hidden capital, some hidden liquidity. So in that regard, if you think that we can be a benefit in analyzing your situation, Aronson on the CPA side or Tyler-Donegan on the corporate real estate side, we're going to provide our contact information following this presentation. And with that, any last comments before we wrap it up? Any summary comments?
I'd like to say one thing, and what we also have seen that I didn't mention, which I know a lot of corporate owners are in that position today. They're doing well, but they're looking at possibly wanting to pull money out of the business. So they're looking at partners to come in to the business and invest cash and buy part of the business from them. Or they're looking at a sale of the business. And the real estate often has a better impact to them, and they have to give away less of the company if they sell the real estate than bring in a partner who may bring in a substantial ownership stake, but also some control and some influence that most entrepreneurs just haven't been used to in running their businesses. So it's an option that fills in a lot of areas within the decisions that corporate owners make in today's volatile marketplace.
That's a great point. Yeah, we wanted to give you a basic or brief overview of corporate sale leasebacks. There's a lot more considerations that need to be looked into. So again, if you want to learn more about it, please contact us. Mario, we appreciate you being here today.
Thanks, Chad. Thanks,
Definitely
Jeff.
enjoyed it.
Pleasure.
Appreciate it.
Thanks, guys.